Welcome to Key Points for April. This month, while we welcome the change in heart by the central banks, reducing the risk of policy error, why financial conditions have eased quite appreciably, and we ask the question, is this as good as it gets for the credit markets? So turning to our first point, there has been quite a profound shift in policy stance by many of the world's central banks. But of course, this has come for a reason. Growth expectations have been cut quite considerably, whether it's the ECB, the Federal Reserve, or the policymakers in China. Indeed, in the case of the Fed, they're now expecting only 2.1% growth this year and 1.9% for next year, coming closer to our own below consensus estimates. Now, what does that mean? When you look at the policy initiatives, the Fed now are saying they're not going to move interest rates higher at all this year. And indeed, for next year, they're only expecting one rate hike, which would mark the peak in the interest rate cycle. The ECB also are not going to move rates higher this year and have implemented another TLTRO funding mechanism for the banks. And we're expecting to see policy initiatives being implemented in China both this month and next month to try and bolster that growth dynamic. Now that takes us to our second point, which is that financial conditions have eased quite considerably. The lower growth dynamic and dovish policy stance has pushed bond yields even lower, and indeed we've got 10-year Bund yields in Germany now back in negative territory for the first time since 2016. Financial assets generally have been rising, and in the case of the United States, a 30-year fixed-rate mortgage has now fallen from 5% to 4%, which is quite a significant boost for households over that 30-year period. So financial conditions are easing, and that's also been a function of the rally that we've seen in equity markets and credit markets, which takes us to our next point. Credit markets have rallied considerably, spreads are back in, and yet the fundamentals continue to deteriorate. Leverage has been rising, and when you look at the risks that investors are taking on for each unit of a leverage, the spread that they're getting, we think these markets are now extended. Consequently, in the months ahead, we think that the credit markets are likely to focus back on fundamentals, which are deteriorating, and this is likely to result in spreads widening again, and it will also have a knock-on effect onto other asset classes. Remember that you can read all of the details that I've spoken about here in our investment insights for April, which is available on zurich.com.